Picture a casino where the rules change daily. The house occasionally vanishes with all the chips, and winning players might still lose everything if they forget their locker combination. Welcome to the world of cryptocurrency investing, where fortune favors not just the bold, but the prepared, the patient, and the perpetually vigilant. Like moths to a flame, investors often find themselves drawn to cryptocurrency markets at precisely the wrong moment. The pattern repeats with clockwork precision. Bitcoin's price shoots skyward, media coverage intensifies, and social media feeds overflow with stories of overnight millionaires. This intoxicating mixture of FOMO, fear of missing out, and apparent easy riches creates a perfect storm that drives waves of new investors into the market, typically just before a devastating crash. Consider this sobering statistic. Bitcoin typically spends only a tiny fraction of its time at or near peak prices during each cycle, often just a matter of days or weeks. Imagine trying to thread a needle while riding a roller coaster. That's essentially what investors attempt when they try to time these market peaks perfectly. The cryptocurrency landscape is littered with the digital remains of failed exchanges, each collapse serving as a stark reminder of the risks inherent in trusting third parties with digital assets. These exchanges, unlike traditional banks, often operate in regulatory gray zones, with security measures that range from robust to remarkably flimsy. Think of cryptocurrency exchanges as digital warehouses in a high-crime area. Some have state-of-the-art security systems, while others might as well have a "Welcome Thieves" sign on their front door. The challenge? It's often impossible to tell which is which until it's too late. The collapse of major exchanges has repeatedly demonstrated that size and reputation offer no guarantee of security. "Not your keys, not your coins" is a mantra in the cryptocurrency world, pushing investors towards self-custody of their digital assets. However, this solution introduces its own set of risks, akin to being your own bank, without any of the security infrastructure that actual banks have developed over centuries. Imagine having your life savings converted into a string of words, your seed phrase, that you must protect perfectly. Lose it? Your funds are gone forever. Store it incorrectly? Hackers might find it. Keep it too secure? You might lock yourself out of your own wealth. This delicate balance between accessibility and security has claimed countless victims, with stories of lost millions due to misplaced or corrupted private keys becoming modern cautionary tales. In the cryptocurrency market, whales, large holders, swim freely in largely unregulated waters, their movements creating waves that can swamp smaller investors. These market manipulators often operate through sophisticated schemes that would be illegal in traditional markets but remain difficult to prevent or prosecute in the crypto space. Picture a pond where a few giant fish can create tsunamis at will, while smaller fish must either ride the waves or risk being washed ashore. Pump and dump schemes, wash trading, and coordinated buying or selling can create artificial price movements that trap unwary investors in losing positions. Edward Snowden's insights reveal a fascinating contradiction at the heart of Bitcoin. While often touted as an anonymous form of money, it's actually more like writing financial transactions on a global billboard. Every transaction is permanently recorded and visible to anyone who cares to look, creating what Snowden calls really bad privacy. This transparency creates a unique risk. Your entire financial history could be exposed and linked to your identity through sophisticated chain analysis. It's like having every purchase you've ever made published in a public database. Fine until it isn't, with potential consequences ranging from targeted scams to personal security risks. The regulatory landscape for cryptocurrencies resembles a global game of musical chairs, where the music could stop at any moment. Countries regularly shift their stance on crypto, sometimes overnight, leaving investors scrambling to understand their position's legality. This regulatory uncertainty adds another layer of risk to cryptocurrency investment. A position that's perfectly legal today might become problematic tomorrow, with consequences ranging from restricted access to outright prohibition. It's like playing chess while the rules are being rewritten. You not only need to plan your moves, but also anticipate how the game itself might change. The technical complexity of cryptocurrency adds another dimension of risk that many investors underestimate. Understanding blockchain technology, smart contracts, and cryptocurrency security isn't just academic. It's practical knowledge that can mean the difference between profit and catastrophic loss. Consider the various attack vectors: smart contract vulnerabilities, phishing schemes, malware, and social engineering attacks. Each requires a different type of vigilance and technical understanding to avoid. It's like being expected to understand both lockpicking and cybersecurity just to keep your savings account safe. Warren Buffett's criticism of cryptocurrency as a non-productive asset hits at a fundamental question: what gives these digital tokens value? Unlike stocks, which represent ownership in companies that produce goods or services, or real estate, which provides utility through its use, cryptocurrency's value relies entirely on market participants' belief in their worth. This philosophical debate has practical implications. If Buffett is right and cryptocurrencies are simply digital tulip bulbs, then current prices could be entirely unsustainable, supported only by speculation and the greater fool theory. The idea that profit depends on finding someone willing to pay more than you did. Despite these risks, the cryptocurrency market continues to attract investors. For those determined to participate, risk management becomes paramount. This includes position sizing. Never invest more than you can afford to lose completely. Security protocols. Implementing robust security measures for both exchange accounts and self-custody solutions. Market education. Understanding the technical, regulatory, and market dynamics that affect cryptocurrency prices. Profit-taking strategy. Developing and sticking to a clear plan for taking profits rather than holding indefinitely. Diversification. Not putting all eggs in the cryptocurrency basket or even in a single cryptocurrency. Market analysis suggests that the current cycle might peak around mid-2025, with potential prices around $250,000 for Bitcoin. However, remember that these predictions are based on historical patterns, in a market that's still relatively young and incredibly volatile. The Pi cycle top indicator, which has historically signaled market peaks, might offer a warning sign around March or April of the cycle peak year. However, like all technical indicators, it's not infallible and should be considered alongside other factors. The cryptocurrency market offers potential opportunities for profit, but these come wrapped in layers of risk that make traditional investment markets look tame by comparison. Success requires not just capital, but time, effort, technical understanding, and emotional discipline. For every crypto millionaire story that makes headlines, there are countless untold stories of losses, both large and small. The statistics suggest that 99% of crypto investors will lose money, even in bullish market conditions. This isn't meant to discourage participation, but to encourage proper preparation and risk management. The crypto market is like a high-stakes game where the rules are complex, the players numerous, and the outcomes uncertain. Those who choose to play should do so with their eyes wide open, understanding that while the potential rewards might be substantial, the risks are equally significant. Remember, in the world of cryptocurrency investment, fortune favors not just the bold, but the prepared, the patient, and the perpetually vigilant. The question isn't just whether you can handle the potential gains, but whether you're prepared for the very real possibility of significant losses.